Hey, what's up, everyone? This is Tom from Wall Street Value. It is Casual Monday here today, March 2nd, 2020. And we are right in the midst of the coronavirus, the fear that's causing the markets to drop like crazy. It's down about 3,500 points over the last couple of weeks. And a lot of people have been asking me, hey, Tom, what are you guys doing in a market like this? Should we get out of the market? Should we sit on cash? Should we start buying? What should we do? And what we're doing right now is we're looking for opportunities. We have stocks that are on our watch list. And what's going to happen with this coronavirus? One of two things I think are going to happen. Number one, it's going to wipe out all mankind. And if that happens, which I doubt, then what happens to our stocks is probably going to be the least of our worries. But if that doesn't happen, if we do find a cure for this virus, just like what happened several years ago with the SARS, it's just going to be a big overreaction. And I understand this is crazy what's going on right now. It's very scary. People, including myself, are afraid to travel. But when something like this does happen to the market, it's going to create a lot of fear. And what Warren Buffett says is buy when others are fearful and sell when others are greedy. So right now, people are fearful. It's causing the stocks to get demolished. And there's great companies that are going to be on sale as a result of this. So just think about Amazon for a minute and Apple. They're two great companies. Apple went from, I believe it's about $330 a share down to about 250 last week, last couple of weeks. Amazon went from about 2,100 down to 1,800. Now, these are just two examples. Do you think the business model for Apple or Amazon, they were awesome companies for the longest time? They're great businesses. Do you think that just all of a sudden over the last couple of weeks, they went from being great companies to horrible companies? Absolutely not. Not at all. It's just the price got beat up because the entire market as a whole has gotten beat up. We want to invest in great companies, great, solid, fundamentally sound businesses, companies that are going to be around for the long term. They have a competitive advantage, but we want to buy those great companies when they are at a discount. And there's only a couple reasons why a great company will be at a discount. One, because something's happening within the company, and hopefully it's just a short-term issue. Something could be happening to the industry as a whole and the industry that it's in, or the market as a whole be going through some turmoil. And that is what's happening right now. So now is a great time, instead of getting scared and selling everything that you have and putting everything in the cash when you're selling at low prices, let's be on the lookout for great businesses that will be available to us at great prices. So I have a list of stocks on my watch list, and I'm patiently waiting for them to come down to a price that I think is a fair price. But I want to share with you something I'm doing also right now. Here's how I'm trading the coronavirus in the short term. So my main goal is to invest in great companies for the long term, stocks I can hold on to forever, ideally, or at least for the long term until it doesn't make sense to own them anymore. So my main strategy is buying value stocks that I can hold on to for a long time. Now, in the short term, there's also things I like to do to profit from whatever the market is presenting to us at that moment. And right now, there's a great trading opportunity for people who are familiar with short-term options trades. So I want to share with you one of the trades I'm doing right now to take advantage of the volatility and the downtrends in the market currently. So I'm going to share my screen with you right now. So this is a trading strategy called the bear call spread. And this is how I'm trading the coronavirus right now in the short term. So the market is in an obvious downtrend. I think it's going to continue to be in a downtrend for the next several weeks at a minimum. Now, right now, the market has a little bit of a bounce back. It's up 150 points, but that's small potatoes compared to what's happened over the last couple of weeks. So therefore, I'm going to do what's called a bear call spread. It's a credit spread, and this is going to take advantage of the increased volatility and take advantage of the decline in the market. So if I were to sell a naked call, that would include unlimited risk. Selling a naked call means I'm going to sell a call option and collect a premium for that, but at some point I'm going to have to close out that trade. And if the market skyrockets, I have to buy something back that could be worth a lot more than what I'm going to sell it for. So I don't want to do that trade. I don't like unlimited risk, so I'm going to buy a call a little bit higher than the short call, and that's going to limit my risk. So this strategy here is for folks who might have a little bit more of an idea of option trading, may have some experience. If that's not you, stay tuned. I'll go through everything and try to explain it as best as I can, because it's something you really should have in your toolbox, because it's a trade that you can definitely profit from anytime the market's going down. So when do we do a bear call spread? If you are bearish, it's also a trade that we can do if you're neutral. This is a trade that we can profit in three market directions. If the stock market is going down, obviously, if the stock doesn't move, and also if the stock that we're trading moves up, just not up too far. We also want to do this for immediate income. And this is another trade that's very good for folks who might just be getting started out and have limited funds to invest. When not to do a bear call spread. So this is a bear market trading strategy. We want to do this when the market is going down. So if you're bullish, we're not going to do this trade. We also don't want to do this during earnings season if we're trading individual stocks, because any number of things could happen during earnings. They could have a positive earnings surprise and this thing could skyrocket in a day or two. So if you're trading individual stocks, we don't want to do this during earnings season. But we can trade this on some of the indexes like the S&P, the Russell 2000, or even maybe one of the Dow Jones ETFs. So setting up this trade, it consists of two transactions. One, we're going to sell a call. That's going to give us our credit, and we're going to sell that call above the price of the underlying stock. Now, to limit our risk, we're also going to sell a call option further away from the underlying stock price. And I'll give you an example in just a moment. So when I do this, I want to make sure that the probability of this ending up out of the money. Now, when we're sellers of options, we want this to expire worthless. I want to make sure that the probability of ending up out of the money is 85% or higher. I want to make sure I'm at least 12% of the way from the current stock price. And I also want to make sure that I'm going to earn at least 3% a month doing this trade. And once again, I'm not going to do this on an individual stock during earnings season. So here's how we set this up. Let's assume that XYZ is trading for $50 a share. What I'm going to do is I'm going to sell a call for $57.50, and I'm going to collect 55 cents in credit for doing that trade. This is going to be a 2-month trade. I'm going to buy a call at $60. So the call that I'm buying is higher than the call that I'm selling. And because it's further away, it's going to cost less money. So this is out of pocket. I'm paying 30 cents for that. Basically, it's an insurance policy. So the net credit is the 55 cents I'm collecting minus the 30 cents I'm paying for that protection. So I'm netting 25 cents on this trade. So the total money at risk is going to be the difference between the spread. So the spread is 57.50 to 60. It's $2.50 minus the credit that I'm receiving, which is 25 cents. So the maximum risk on this trade is $2.50 minus the quarter I'm getting paid. So it's $2.25. So the maximum profit is that immediate credit that we collect, 25 cents. That's the most we're going to make on this trade. And the risk is a little bit higher, but we're willing to do this trade because the probability of success is so high. All right, so the long call at 60, that's going to be our insurance policy. If the stock goes up to infinity, that's okay because this is not an unlimited risk transaction. We're buying that $60 call to protect ourselves. So the maximum loss is $57.50 to $60. That's known as a spread minus the credit 25 cents. So we could lose $2.25 if this thing completely blows up in our face. And I'm not going to teach you in this video because this is just a quick one just to introduce the strategy to you. But in other videos, I'll show you how to limit the losses, how to do stop losses, and also what our rules are to get out of a trade early if it's not working to our advantage. The total net credit goes into your account the very next trading day. And here's how the trade's going to look again. We're to sell. So the stock's at $50 a share. So the stock's right here. We're going to sell a covered call or a call above the price of the stock. And we're going to buy a call even further for the protection. So we're selling the 57.50 calls, collecting 55 cents. We're going to buy the protection a little bit higher. It's going to cost us 30 cents. Net credit is $25. And when you're doing an option contract, one contract represents 100 shares. So we're going to collect $25 for this trade. Not a lot, but it's only one contract. If you're trading with a decent amount of money, I think you could make, $250 if we're doing 10 contracts. So as with all credit spreads, the maximum possible gain is limited to the credit that we're collecting. So we're collecting, in this example, $25. And at expiration, if the underlying stock closes below the short strike price, which is $57.50, we're going to collect that maximum profit. So $25 might not sound like a whole lot, but I'm going to show you what the rate of return is right now. So here's how you figure that out. You take the net credit, 25 cents, or divide that by the money at risk. That's going to equal the rate of return. So net credit's a quarter, money at risk is $2.25. Divide those two together, we're making 11%. We're making 11% on this trade, and we don't even have to be correct in which way the market goes. And I'll explain that to you in a second. So how can we win doing this trade? The price of the underlying stock when we place the trades at 50. If the stock closes below 50, we won. We made the maximum profit. Remember, this is a bear market strategy. We want the stock to go down. But even if it doesn't go down, we can still win. If the stock doesn't move at all and it stays right around $50 a share, maybe it went to 48 or 49 or 52, 53, whatever, we still made the maximum profit. And the stock can also go up and we can win. It just can't go up too far. So we sold the call at 57.50, and as long as the stock closes below 57.50 during the length of time that we're in this trade, we will still make money. So here's how it looks. The stock is right here at $50 a share. We want the stock to go down, and as long as it goes down, we're fine. But if it stays anywhere within this range, if it stays between 50 and 57.50, so even if the stock goes up, it's a bear market trade. We thought it's going to go down. We were wrong. As long as it goes up, but not too far up, not up to 57.50, we're still profitable. So we can earn 11% in just 2 months. In this example is a 2-month trade, and you don't even have to be correct in the direction in which the stock moved. You just can't be very wrong. This trade allows us to make money in 3 directions. So the stock has to go up by 15% in just 2 months in order for us to be wrong. And that's a risk that I'm willing to take any day of the week. So that's it. That's the bear market trade. It's called the bear call spread. That's what I'm doing right now, in addition to revisiting those stocks that are on my watch list and waiting for those great companies to come down to a price that I think makes sense. So if you want to learn more about finding great companies to invest in for the long term, as well as the strategy that we use for short-term trading, please reach out to me at any time. My email is tom@wallstreetvalue.com. And we do teach an 8-week class on stock investing and options trading. And if you're interested in that, here's some of the topics that we teach. Where to find stocks to invest in right now. We teach how to analyze a business, how to know what a stock is worth, how to copy the greatest investors on Wall Street, such as Warren Buffett. There's ways that we can find out what he's buying or selling right now. And that's what we're going to teach in this class. We also go over some of the short-term trades that we use with a 90% or greater winning percentage, such as the bear call spread. Teach you how to profit if the market is up, down, or flat, and how to generate monthly income using option trades. Also, please hit that subscribe button below and stay up to date on all of our latest videos regarding all cool things stock investing and options trading related. So that's it for this video. If you have any questions, I'd love to answer them for you. So leave a comment below, and I'll be keeping an eye out for those comments, and I'd be happy to answer any questions that you may have. So thanks a lot for watching. I really appreciate it, and hope to hear from you soon. Take care.